You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Hope you've been doing great. Lately, I've had many discussions with clients where they are unsure of how much life insurance that they should have. So I thought I would cover some of the ways for you to think through this to help you figure out an amount to apply for. There are some different methods to help you figure out how much coverage you should have. And as I've mentioned before, life insurance companies have a certain maximum for different age groups. The insurance company's calculation is your income times a certain number of years. And so I'll go through one of these charts that I just pulled right out of an underwriting guide from an insurance company as an example, so you can understand that for ages 18 to 35, their multiple is 30. So if you're 30 years old and you make $100,000, you would multiply that by 30 to get the total amount that you would be insurable for, $3 million. The next age bracket is 36 to 45, and that multiple would be 25 times earned income. For ages 46 to 60, that would be 20 times your earned income and insurance that you could apply for. For ages 61 to 65, it's 10 times your earned income, and age 66 plus would be 5 times your income. We would be able to use a multiple of your household income, so it doesn't have to be your own personal earned income, which is good for those times when you want to get coverage for a spouse who is not working outside the house, who is a homemaker, because there is a huge value to that person who's taking care of the home, especially with children in the house. And if that homemaker was to pass away, the working spouse may need to hire a nanny, a cook, a person to clean the house. It can get expensive. So there is definitely human value on the non-working spouse as well when it comes to figuring out life insurance values. Now, anytime you're applying for coverage that's over $5 million in death benefit, the company will want to see supporting financial documents, such as income tax returns. They usually want to see at least 2 years of income tax returns. And of course, the specifics that I'm giving you now apply to the companies that I work with. They may not all have the same guidelines or requirements. If your income times the multiple isn't large enough to get you the coverage that you desire or that you want to apply for, but you have significant assets or significant net worth, then they will make an exception to the multiples that I gave you. You would just need to supply the supporting financial documents. But even locking in your maximum coverage that the insurance company will allow, it is not likely to be what you would be able to earn in total over your working years. It doesn't factor in raises, promotions, bonuses, or maybe even the full amount of years you plan to still be working. And if you're married with children, your full income till your retirement years may be what your survivors will actually need if you were to pass away during your working years. Your human life value represents your total financial worth, your economic value considering your future earnings and contributions. This includes current and future financial obligations, income, future earning capacity, education level, occupation, and your expected remaining lifespan. Again, life insurance companies have a formula for figuring out your estimated human life value, as I just went over with that chart. There are different approaches you can use when trying to figure out how much life insurance you should apply for. First of all, there's the 10 times rule that I'm sure many of you have heard about. I've heard lots of people mention that to me. This is a very basic method, but can work as a base to get started. It just means to multiply your annual salary by 10 to come up with how much life insurance you need. So if your income is $100,000, the lowest coverage you would want to have is $1 million. Another way you could come up with an amount is to take your annual salary, add your mortgage balance, add any other debts you have, such as car payments, school loans, other types of loans or credit cards, etc., and large future expenses that you can foresee, such as maybe college expenses or a wedding. You can take that total number and subtract out your liquid assets, such as savings accounts, existing college funds, and any other current insurance. When adding up your existing life insurance, I would be careful not to put too much weight on group life insurance that you may have through work, as this will eventually go away. It will definitely go away when you retire, but it can also go away if your employer simply decides to change their benefit plan or you switch jobs. Your new employer may not offer life insurance benefits, or they could simply be lower. A lot of times people think, oh, well, I have plenty of insurance coverage because I have some through my work. And so if I lose my work coverage, I will just apply for it then. I'll apply for the life insurance then. I don't have it through work anymore. But 20 years later, your health might not be in as great of condition as it is now. You may have some health conditions that will cause a lower than average health rating, or you may be completely uninsurable, or you may go through a terrible illness that you'll have to wait another 5 years to apply if you're able to stay healthy for those 5 years. You just never know. So when it comes to insurance offered through an employer, I say to take whatever you can, because they will either be covering the cost for you or it will be a really low cost, very inexpensive. So it's great to get it at that low price. I would also just try to obtain my own maximum coverage through individual policies to lock in as much of my human life value as possible. Another popular method for figuring out how much coverage you should have is called the DIME method. This stands for debts, income, mortgage balance, and estimated future education costs. You would take your existing debts, your annual income, times the number of years you estimate your dependents would need to live off of that income, plus your remaining mortgage balance, plus any estimated education costs for your children. People often factor in any debts that are currently outstanding that they would want to be paid off. However, they don't think about the income that they would want to continue if for their loved ones and for how long they would want the income to continue. If your spouse is a homemaker, depending on your income and you were to pass away, how long would you want your income to take care of your spouse? 1 year, 2 years? What if your spouse has been out of the workforce for a really long time? Would your survivor be able to go out and earn as much income as you were earning? Or would that person need to go out now and get 5 jobs just to maintain the household? In the midst of a tragedy, the last thing you want your loved ones to be worried about is how they're going to pay the mortgage or how they're going to put food on the table tomorrow, or to realize they suddenly have to move in the midst of not knowing where their next dollar is coming from and needing to go out and get 2 or 3 jobs to make ends meet, which means they will need full-time childcare if there are children in the picture. Maybe your survivor would have to put the house on the market soon after the funeral is wrapped up. Can you imagine the added stress and difficulty this would bring to your family? And all while in mourning and feeling a deep, deep hole of sadness, it just adds more tragedy to the family. All this to say that if you're not going to apply for your maximum insurability, it's a good idea to factor in some amount for ongoing income needs. If you're an income earner within your family, you should also account for the fact that you are no longer contributing to your retirement account if you pass away during your working years. Your survivor may have been heavily dependent on the savings you are putting away into your retirement for their own retirement. If you're already in retirement, consider the need for long-term care in your future. If you have a long-term care policy, that's super great. But would it be enough if you or your spouse were to need home care or assisted living? I have clients who have acquired long-term care policies years ago, and at that time, their monthly benefit for long-term care seemed really great, but now it seems way too low. So even in retirement, a death benefit can save the financial life of your survivor or your survivors. It could provide the additional resources they need to live their life in comfort, because we all know how prices only go up over time. It could help provide added resources for your survivor if they were to need assisted living or extra care. And for those who have plenty of assets and feel, I don't need life insurance because I have plenty of wealth and assets, I'll be fine. Well, you might want to consider it if you may end up with a hefty estate tax after your passing. This way, your family isn't struggling and rushing to sell the business, sell the rental property, the vacation property, or the family home just to meet the estate taxes that may come due in 9 months. Well, I hope this episode was helpful to you in some way. I hope it helps when you're pondering the total amount of coverage that you would want to have in force for your survivor to protect your family. Because remember that when we are building a whole life policy for the purpose of the infinite banking concept, we are shrinking the death benefit down in order so that your dollars are growing as efficiently as possible for you to be able to use during your lifetime. And we don't want to leave your family unprotected. So as always, if you're feeling ready to get started and would like to partner with me as your advisor, if you're ready to share your current financial picture and your goals so that I can assist you in the best possible way, please feel free to reach out. You can reach me at valerie@alphaomegawealth.com, and I would love to meet you. Thank you for listening, and I hope you have a great week.
This is the podcastfactory.com.